Hi and welcome. You're listening to the X22 Report. My name is Dave and this is episode 1092A and today's date is October 4th, 2016 and the title of the episode is The Bond Market is Flashing Red. Something is about to happen. Let's get into the economic collapse financial news. Now today on the market we see the market has come down. We also see gold being suppressed quite a bit. And when I'm looking at this, I'm thinking to myself, and I looked in the past, when gold has been suppressed so much, we can expect something to happen in the economy financially. This is kind of like a warning because they know once this occurs, this event, financial event occurs, gold is going to shoot up. And we can see right now they're preparing for this event by dropping gold quite a bit. And we see that the economy in total is rapidly falling apart. I mean, Ericsson is laying off 3,000 employees. Cypress Semiconductor, 500. More financial companies are laying off. We're going to see additional companies lay off more employees. This is not going to stop. And we're starting to see many things occur at once. I mean, we look at the subprime auto loan market. Things are just turning ugly. Delinquencies, losses, they're soaring right now. And we can see right now that they create these subprime loans, they package them, repackage them into auto loan-backed securities, ABS, and then sell them to investors, maybe to pension funds because they want a high yield. But right now, delinquencies of 60 days and higher among the subprime auto ABS increased by 22% year over year in August. This is coming from Fitch Rating. Subprime annualized losses increased by 27% year over year, reaching 8.9% of the outstanding balances of auto ABS. Even delinquencies among prime borrowers are rising. The delinquencies of 60 days or more increased by 17% from a year ago. And when we look at the auto loan market right now, when we came tumbling down in 2008 moving into 2009, auto loans were about $815 billion. Well, to blow this bubble up, we are at $1 trillion right now. They pushed it up hard because this is what the central bankers needed to control. Remember, they can control things that have to do with loans. Where people go purchase a car, they can say no money down, we don't care what your credit is, you drive away with a nice shiny car and you didn't put any money down. Of course, later on you can't pay for it, but they don't care about that. As long as they spread the debt out. Same thing with housing, same thing with student loans. What they can't control is people going to the store and spending in retail. And that's why that's contracting quite a bit. Even the auto loan market, that is contracting, but the bubble, the auto loan bubble, is ready to pop. Now, we've talked about real estate and how real estate around the country is starting to decline rapidly. In the Hamptons, New York, San Francisco, the outlying areas. And we see New York City apartment owners. Well, it looks like we have a problem there. It's in free-for-all. This is coming from an Element report. The number of apartment closings plunged by 18.6% year on year, while apartments sat on the market an average of 8.2% longer. Inventory also spiked, with resale inventory up by 8.2%. And new development inventory up a massive 27.2%. Condo sales, we're seeing they're declining by 20% year on year. And the condo inventory is rising by 15%. So we're starting to see a huge breakdown in the real estate market. So we have the auto loan bubble. We have the real estate bubble. These two are popping. The student loan bubble, complete mess. We're seeing the derivative market getting ready to collapse. And the bond market is getting ready to collapse. All of this is happening at once. And when we look at the economic indicators, where these indicators affect the everyday person, we can see these are continually declining. They're not getting better. I mean, for the second month in a row, New York purchasing managers saw a contraction in the ISM, New York ISM, printed at 49.6. We see that New York employment crashed from 54.9 to 33.9. It's the biggest drop ever as far back as June of 2009. Most likely this means nothing's going on here. Of course it does. The system is coming down. We see the Baltic Dry Index. It is continually dropping now, 860 points down, another 4 points. Now we see the United States government, they closed out the 2016 fiscal year that ended a few days ago on September 30th with a debt level of $19.5 trillion. That's an increase of $1.4 trillion over last year's fiscal year close. So what exactly did we the people get from this? Because they borrowed $1.4 trillion. Did they spend $1.4 trillion on achieving world peace? No, actually they made more. Eradicating poverty? No, more people are on food stamps, more people are out of jobs, more people are homeless. Saving the planet? No. So, did they fix the infrastructure of the United States? No. What exactly did they spend this money on? Well, we know what they spent it on. They spent it on war. They spent it on other countries. They spent it on coup d'etats. They spent it on everything but the people. Given to foreign governments. And we can see right now that as this continues, this country is doomed. Because if they borrowed $1.4 trillion, they're going to have to borrow even more and more. Because there's no way the revenue can pay for this debt, the interest on the debt, even though it's close to zero. They just can't do it. That's the only reason the system is continually operating. We have Japan, we have Europe at negative interest rates, and we have the U.S. close to zero, which most likely will end up going negative. And we see the IMF is out there saying that they're seeing price inflation, and it will be surpassing the Federal Reserve's 2% in 2017. They're saying it's going to reach 2.3% or more. Well, we know that inflation is much higher right now. We know the Fed, the U.S. government, central bankers, they play games with the calculations of unemployment, of inflation, of GDP. What they do is they create these numbers to fit their policy. We see the IMF is out there once again, revising their numbers. And we see that GDP in the U.S., well, it's no longer going to be 2.2%. They revised it lower once again to 1.6%. Remember when they started out at 3.5%? Well, it has dropped by almost half now. They're saying next year's forecast is already down to 2.2%. Well, we know this is going to go much, much lower. We know whenever they say the GDP number is going to be high, we know it's going to be very low. And this is, again, the manipulated number. It includes Obamacare. They went back with research and development all the way back to 1929, recalculated GDP from that period on, and they continually revise and manipulate these numbers. We see the IMF is cutting Canada's GDP. They're going from 1.4 to 1.2% now. We see Italy is preparing for a Deutsche Bank crisis. Now, this is a hypothetical crisis, but they're preparing for it. Now, once they say hypothetical, once they say they're having a drill or they're preparing for something, we know for a fact they're doing this on purpose and getting ready for what is about to come. And we can see from the bond market that something massive is coming our way. The bond market is flashing red right now. When we look at the stock market, the stock market's about 69 trillion in size, and they're trading about 191 billion in shares per day. The bond market is much larger. It's 140 trillion and trade about 700 billion in volume per day. The bond market is the smart money and reacts to major policy changes before stocks. On that note, the bond market has realized QE is ending in Europe and Japan. Most likely will continue covertly. But we can see right now, in July, the bond market signaled that something big is coming to the markets. The yield on the 10-year Treasury, the 10-year JGB, and the 10-year Bunds rocketed higher. Stocks have started tracking bonds this year, and with bonds now selling off, stocks are on borrowed time. Over 550 trillion in derivative trades based on interest rates. If the bond market really starts to go, we're facing a major crisis. It'll be larger than 2008. It will make 2008 look like nothing. And right now, the bond market is signaling something is about to happen. Remember 1 week or 2 weeks ago when the dollar was signaling something was about to happen, and all of a sudden Deutsche Bank came up. Now we see the bond market is telling us something's about to happen. And at the same time this is signaling that something's coming, gold is brought down quite a bit. So when we look at this entire situation, we see something in the financial realm, an event in the financial realm is about to happen. And it's going to be big. This could be the October surprise. But we see at this point, if you are not prepared at this time, start getting prepared. If you have been preparing, I would continue and maybe ramp it up a little bit. Because what we're seeing right now is this system, it's tearing itself apart. How much longer the central banks will be able to hold this together, we don't know. Now, a lot of people are out there and they say, well, this system won't collapse. The central banks won't let it. Well, I think the central banks are going to let it. I think they need more ammo. I think they need legislation. I think they need to bring it down to scare Congress, to scare the people, and allowing them more control of the system. This is what they want. Remember, the central bank has a mandate right now here in the U.S., and they need to override that mandate, and they need to get more power. So when people say, well, this is going to be a long, slow, grinding, drawn-out crisis, I don't think so, because the central banks are at the end of what they can do. They need to pass legislation to allow them to do more. I mean, is it going to benefit the people? No, absolutely not. So we will feel some type of collapse. Think about what they did in 2008. They went into Congress, they were fear-mongering, and then Congress voted, and all of a sudden billions and billions of dollars were going to financial institutions, to corporations, allowing the central bank to start printing a huge amount of currency. Well, the central bank is getting ready to do the same thing. And the only way to do this, the only way to get more power, is to have some type of financial event. And this is what is coming. This will be phase 1. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.